Goldman Sachs is currently tracking a massive institutional stock dump, one that could begin pulling down your portfolio this very week. For anyone holding standard index funds or popular tech names, the window to prepare for this institutional shift is closing fast. It is easy to look at a brokerage account right now, see double-digit gains driven by artificial intelligence hype, and feel secure about your financial future. But while those retail numbers look green, the institutional giants who control the market are already securing the exits. By the time the general public reacts to a drop, the smart money has often moved on, leaving latecomers to absorb the losses. While everyday traders are celebrating recent market bumps, hedge funds and institutional players are quietly building the largest short positions we have tracked since the 2022 bear market. Later in this video, I will show you the exact chart Goldman Sachs is using to time this upcoming correction. Before we get to that, we need to answer two immediate questions. How deep will this drop actually go, and who exactly is pushing the sell buttons? Retail traders are operating under a set of hidden, programmed rules. Without understanding how institutional money is positioned, those recent portfolio gains are at risk of being wiped out. This institutional withdrawal is a synchronized global event. Major players across all major world markets, from Tokyo to Frankfurt to Wall Street, are pulling back simultaneously. This chart from Goldman Sachs' prime brokerage desk shows the evidence. Institutional equity exposure has been net selling for 4 consecutive weeks, dropping well below the zero line. The primary catalyst behind the selling pressure comes from systematic funds and commodity trading advisors, or CTAs. These entities use computers to execute trades automatically based on strict numerical thresholds. If the market breaches specific support levels, these CTAs are mathematically programmed to automatically unload up to $80 billion worth of stock over the next 30 days. Add traditional pension funds to the mix, and we are looking at an additional $23 billion of selling pressure hitting the market by the end of the month. Because these multi-billion-dollar trades are executed by algorithms, they create unstoppable downward momentum. The computers ignore traditional market fundamentals, trapping investors who aren't watching the technical levels. The first macro trigger causing this automated dump is a liquidity vacuum. Central banks are draining cash from the financial system faster than the broader economy can adapt. The second trigger is the tech bubble paradox. A tiny fraction of mega-cap technology stocks have carried almost the entirety of the market's recent growth. That creates a dangerously crowded trade. When thousands of funds try to cash out of the exact same overvalued tech stocks simultaneously, the market infrastructure can break under the volume. The third trigger is happening inside the companies themselves. Recent filings show that corporate executives are aggressively selling off their own shares at a pace that suggests they see a peak the public hasn't recognized yet. You have CEOs claiming publicly that their businesses are strong, while they privately cash out millions in personal stock ahead of a broader market decline. This raises the critical question of what specific price levels will accelerate this algorithmic panic, and which sectors might actually survive the rotation. The combination of tightening liquidity, crowded tech trades, and aggressive insider dumping acts as a lit match in a room full of automated algorithmic gasoline. During a market correction, stock market wealth is never truly destroyed. It is simply transferred from those who panic to those who prepared. There is a reason investors like Warren Buffett advocate for being greedy when others are fearful. Historical market crashes consistently create wealth for patient capital. The psychological difference is stark. Everyday investors let fear dictate their moves, locking in losses at the bottom. The smart money patiently waits on the sidelines for high-quality assets to become mispriced. Surviving this specific market environment requires abandoning emotional retail habits entirely. You have to adopt the exact defensive strategy used by institutional giants. The first step in this institutional protocol is raising tactical cash immediately. You need dry powder available to deploy when the market actually hits the bottom. The second step is targeting unbreakable stocks. Focus on high-moat companies with real, tangible earnings and zero debt that can survive a prolonged liquidity vacuum. The final step involves volatility hedging. You can use small, calculated options positions that generate profit as the broader market drops, offsetting your long-term holdings. This is the Goldman Sachs target chart. This S&P 500 graph maps a buy zone 12 to 15% below the peak. Reaching this level triggers the largest institutional buy program in history. That's when you deploy your cash. The data is moving quickly, forcing a choice. Will you panic like the uneducated crowd or prepare like smart money? Comment protect if you are holding cash, or buy dip if you're ready to attack. Hit subscribe so you don't miss our upcoming guide on exact positioning for 2026.